What if I told you that your tax bill isn't a final verdict, it's a choice? And I'm not talking about some shady trick or a loophole that will come back to haunt you. I'm talking about a choice that's hidden in a rule book over 2,000 pages long that almost nobody ever reads. Stick with me, and I'll translate that rule book into plain English so you can legally keep more of your hard-earned paycheck. Now, a quick disclaimer. I am a licensed attorney, but I'm not asterisk. You're asterisk attorney. This video is for educational purposes only, not personal legal advice. If you want to apply any of these strategies, you need to talk to a qualified professional who understands your specific situation. If you do it wrong, you could face penalties. But if you do it right, you'll wonder why you didn't start this years ago. It's crazy, but most Americans spend more time planning a weekend getaway than they do planning their taxes. And that's exactly why so many people overpay. The tax code is designed to reward people who take certain kinds of risks like investors and business owners, while it taxes pure wages the hardest. If you only earn a W-2 paycheck, you're driving in the ordinary income lane, which is the highest tax lane there is. For single filers, it looks something like this. The first chunk of your income, under about $12,000, is taxed around 10%. Then it jumps to 12%, 22%, 24%, and all the way up to 37% on your highest earnings. And that's all before Social Security, Medicare, and any state income tax you might owe. Now, let's compare that to the lane for long-term investment profits. That's gains on assets you've held for more than a year. There's a completely different world. The tax rate is 0% for lower incomes, 15% for a massive middle bracket, and only 20% at the very top. Plus, there's no Social Security or Medicare tax on capital gains. Let's make this real. In scenario, you earn a $100,000 salary from your job. So, how do you start using these rules to your advantage? Let's talk about some basic investor tools. First up, tax loss harvesting. Let's say you own 2 stocks. Just be careful of the wash or sell rule. If you sell a stock for a loss and then buy back that same stock or a nearly identical one within 30 days, the IRS won't let you claim that loss. The solution: just wait at least 31 days before you buy it back. Next, let's talk about retirement accounts. These are like protective wrappers that let your money grow in a tax-advantaged way. With a traditional IRA or a 401k, you don't pay tax on your contributions today. You pay it when you withdraw the money in retirement. With a Roth IRA or Roth 401k, it's the opposite. You pay taxes now, and your qualified withdrawals later on are completely tax-free. Inside these accounts, your investments can grow and compound year after year without you having to pay annual capital gains taxes. I hear it all the time. But I make too much money to contribute to a Roth IRA. You might want to look into a backdoor Roth. If your income is above the limit for direct contributions, you can often make a non-deductible contribution to a traditional IRA and then immediately convert it to a Roth. The rules here can be tricky, especially if you have other pre-tax IRA money. So this is definitely one to discuss with a pro. And what if the annual contribution limit of around $7,000 just isn't enough? You can build a bigger bucket. If you're self-employed, a freelancer, or have a side hustle, check out a SEP IRA or a solo 401k. A SEP IRA can allow you to contribute up to 25% of your compensation, with generous annual caps. A solo 401k often gives you a Roth option, too, giving you incredible flexibility. Now let's get into real estate, a powerful tool for income, deductions, and even paper losses. Imagine you buy a rental property for $200,000. Let's say the land is worth $30,000 and the building is worth $170,000. Yeah, rent it out for $2,000 a month, bringing in $24,000 a year. After all your expenses, property taxes, insurance, maintenance, you have a $10,000 cash profit in your pocket. But your taxable income isn't $10,000. The tax code gives you a magical deduction called depreciation. This is a non-cash write-off for the building's wear and tear. For a residential property, you divide the building's value over 27.5 years. So, $170,000 divided by 27.5 is about $6,100 a year. That depreciation deduction reduces your $10,000 profit down to just $3,900 of taxable income. And you can also deduct other business expenses, like your phone, laptop, and mileage to the property. Just remember to document everything. Want to get even more advanced? You can use strategies like accelerated depreciation, often through a cost segregation study, to front-load those deductions. It's possible to have a positive cash flow from your rental while showing a loss on your tax return. And sometimes, those paper losses can even offset your W-2 income. This is advanced territory, so make sure you're working with a tax pro who specializes in real estate. Finally, let's talk about business ownership. When you start a small business or a legitimate side hustle, the tax code treats you like a partner in growing the economy. You can deduct all ordinary and necessary expenses to run your business. That means Wi-Fi, software, travel, and even a home office if it qualifies. Two huge levers here are Section 179 and the QBI deduction. Section 179 allows you to deduct the full purchase price of qualifying equipment, including heavy business vehicles, in the year you buy them. Yes, that G-Wagon might qualify by weight, but you must have meticulous logs to prove its business use. No faking it here. The other is the qualified business income, or QBI deduction. This allows many small businesses to deduct up to 20% of their business income. So, if your business has $100,000 in profit, a $20,000 deduction could mean you only pay tax on $80,000. It's incredibly powerful. So, how do wealthy individuals put this all together? They strategically shift their income from the high-tax wage lane into the lower-tax investment and business lanes. They use tax-advantaged accounts, they harvest losses, and they own assets that generate deductions like depreciation. Most importantly, they document everything and hire professionals who focus on strategy, not just filing forms. Think about that business trip to Hawaii. Travel can be deductible if its primary purpose is business. You could be meeting brokers, touring properties, or attending a conference. Keep detailed agendas, receipts, and notes. The business purpose has to be real. The bottom line is this: the tax code is a playbook. If all your income comes from a regular job, you're likely paying the highest rates. But if you learn to shift into the lanes that the system rewards owning assets, running a business, and investing for the long term, you can legally and predictably keep more of every dollar you earn. So ask yourself, this year, which lane are you going to choose? If this was helpful, drop your biggest tax question in the comments below. Share this with a friend who needs to hear it, and make sure you hit that subscribe button. Thanks for watching, and I'll see you in the next video.